People are applying for fewer mortgages than they have done for more than 25 years. New home sales are down 35%, and higher interest rates are making it more expensive for Americans to buy homes. Yet the housing market has rebounded from worse conditions than these, and historically, homes appreciate in value over time. Financial pros are taking a hard look at home builders according to data from Trackstar, our proprietary sentiment indicator, and the SPDR S&P Homebuilders ETF, which we rate at 8 out of 10, was a Financial Pros most searched homebuilder ETF and one of the top ETF searches during December. So, with the housing market cooling off, is it time to get into this ETF? XHB tracks the home building segment of the S&P Total Market Index. The ETF has a diversified portfolio spread over 6 industries within the home building sector, of which building products and home builders are its largest exposure. That's an important point because XHB isn't a pure play on home builders, rather it's an ETF that plays on the health of the home building industry. XHB began trading on January the 31st, 2006, and over the last 10 years, it has produced solid annual returns. Shares in the ETF are actively traded, and it's both optionable and shortable, and it pays an annual dividend. Investors seeking exposure to home builders via ETFs have a few options besides XHB, which vary in composition and investment style. XHB has an expense ratio, which is less than most other home building ETFs. And when it comes to dividends, XHB is mid-range in the peer group, and it's a similar story if we compare 3-year performance. Higher rates make it more expensive to buy homes, and there have been the fewest mortgage applications in more than 25 years. 2022 was tough on XHB, and that may continue this year. But no one can time the market perfectly, and historically, the ETF has posted strong returns. That's why we think nibbling on shares here makes sense, as does buying more if XHB dips further.